Hello, my name is Bruce Lazear. I'm a founder and partner in Lazear Capital Partners. And our discussion today is the impact of potential tax law changes as proposed by the Biden tax plan and as it affects ESOP transactions. We've had 4 years of the same tax rates, and the Biden tax plan proposes to change them, and the changing of the tax plan changes outcomes. And the value of ESOPs, candidly, there's many values, employee ownership and the enrichment of the team, but one of the other ones is there are two significant tax benefits under current law. And the first one is our sellers can sell under Section 1042 of the Internal Revenue Code on a tax-deferred and ultimately tax-free basis. So the benefit is that you can sell your company and never pay the income tax, the capital gains rates that you'd otherwise pay. The other one is that the company can be a tax-free entity if it is owned by an S corporation when we're done. The tax changes we're going to talk about are primarily related to the effect on the selling shareholder of changes in the proposed tax law. So with no further ado, I'll get started with the substance of this discussion. Currently, the long-term capital gains rate is 20%, and the proposal is to increase it to 39.6%. So let's kind of talk about that. So if you had a taxable gain of $10 million, because I like round numbers, under current law, you'd give $2 million to the federal government if you had a $10 million taxable gain, and you'd be left with $8 million. However, and that's ignoring state of Ohio. The state of Ohio, or most states, around 5% is the state. So realistically, if you had a $10 million gain, you'd have about $7.5 million left over. In an ESOP transaction, that changes dramatically because you potentially have $10 million left over. $2.5 million more. And if you think about that $2.5 million, it's 1/3 more money because all you were going to get in a taxable transaction is $7.5 million. Here, you're getting an additional $2.5 million. 2.5 over the 7.5 in a fraction that you would have gotten elsewhere is 1/3 more money. So it's a very significant increase. Another way to express this might be to say, if you sold to anyone else other than ESOP, and you got, well, if you sold to an ESOP and got 6 times your EBITDA, it would take 8 times from any other buyer to net of that tax obligation give you 6 times. It's the reason why ESOPs are capable of paying more net of tax than other buyers, as a typical matter. So that's with a 20% federal tax rate and 5% state tax rate. So what does the Biden plan say? The Biden plan wants to increase the tax rate on capital gains to 39.6% from 20%. So that's almost double. That's easy math. So if you sold in and let's talk about whether this tax rate's going to change. No one knows what they're going to be. I've started my career as a tax lawyer 36 years ago. What I've learned from many changes to the tax code is nobody knows what's going to happen next. You might think you do, you don't. I also know that the change is not tomorrow. It really isn't. The change in the tax code typically happens a year or so into the next presidency. President Trump was sworn on January 20th, 2017, and the tax law that was the Revised Tax Act with our current rates wasn't passed until much later, late December 2017. And right now, because of the COVID recession, the future Fed Chairman, Janet Yellen, or Secretary of Treasury, Janet Yellen, has said that she does not believe that there will be a tax change this year, 2021, because we're in a recovery mode, and raising taxes right now is probably not a great idea during a recession. In fact, go back to Herbert Hoover, he raised taxes during the Great Depression, and it exacerbated and extended the Great Depression. So I don't see a tax rate this year, but 22, maybe, 23 almost certainly a tax increase. So when we start talking about these different rates, nobody knows what rates we're really going to have, and they're not going to be tomorrow. But 39.6% is his proposal. If you had 39.6% plus 5%, you'd have 45% tax rate on capital gains, up from 25 today. Remember earlier I said that 6 from an ESOP is as good as 8 from anyone else? The math actually changes where 6 from an ESOP is as good as 11 times EBITDA from anybody else. So it's a tremendous increase in tax rates if it were to occur at that rate. Personally, for whatever it's worth, knowing that I don't know any more than anyone else does, I do look back at history, and the highest capital gains rates that I can recall in my lifetime are 28%. Not 39.6, but 28. A 28% tax rate back to my equivalent of 6 times EBITDA from an ESOP would take 9 times from anyone else to get to the same equivalence. So what we're really talking about here is a significant tax burden on sellers in non-ESOP transactions that may be avoided by ESOP transactions. And I always say that the value of good tax planning is proportionate to the tax rates, meaning high tax rates mean avoiding tax is way more valuable than where tax rates are low. So the first point I want to make to you is that the capital gains rates changes that are proposed are an issue. The second thing I want to talk about is something called the installment sales method. For non-tax people, what that means is in a situation where you don't get all your money at closing, you get, let's say, part of your money at closing and the additional money comes in future years. The tax code has an election that allows you to pay the tax when you actually get the money. And it makes perfect sense. Think about it. If I got 10 million today and I got 2 million a year for the next 3 years, why should I pay the tax today on those on the future 2 plus 2 plus 2, 6 million? Because it would drain me of funds to pay all that tax. So the Internal Revenue Code provides a very good benefit called the installment sales method. You can pay the tax when you actually get the money. And everybody who's smart is going to take that for deferred money in any transaction. One of the things going on, though, is if you sold your company under today's tax rates, which is 20% federal and 5% state, but you got your money in 21, 22, 23, 24, well, 22, 23, and 24, the tax rates could be higher. These tax law changes will affect you if you get money post-closing. So in a non-ESOP transaction that's not under 1042, let's say you took contingent purchase price paid in future years. You don't know the tax rate for when you get that money. You do not know the tax rate, and you could find yourself paying a much higher tax rate in those out years than you might have otherwise anticipated. So something to be cognizant of is when you get the money is when the tax rates are important. And many, many private business owners sell with deferred money, some money they don't get at closing, and that will all be subject to the tax rates that occur when we get there. So I just wanted to give an overview of this concept that deferral of purchase price means you take the risk of higher tax rates even more so. I, for one, believe there'll be no tax law changes in 21, but 22 is quite probable. 23 is basically assured. Let's talk about other changes in the tax code. Proposed. None of these have been passed. C Corp rates, which is if you don't have an S corporation or an LLC where you're the taxpayer, not the entity. Where the C Corp is a taxpayer, they're a taxpayer for tax law purposes. The proposal is to increase that tax rate from 21% to 27%. You know, that's a big increase. And so your C Corp structures will be more burdened by income taxation. Another element that's very, very important for business owners is what we call QBI, Qualified Business Income. You may not know what those words mean, but many of you know the benefit of it. Right now, if you're non-professional services, so you are a manufacturer, a construction company, a distribution business, a trucker, all of those businesses, non-professional service, and professional service would be lawyers and accountants and financial advisors, investment bankers like our firm. All of us don't get the benefit of this. And the rule is that if you are a non-professional services firm, you get a big tax break. It's called QBI, Qualified Business Income. And basically, it takes your tax rate down to 29.6%, whereas right now, professional services are 37%. Well, Biden's proposal is unclear as to timing, but it talks about the phase out of qualified business income. So if you're that manufacturer or construction company, today your federal income tax rate's 29.6%. Once phased in, you wouldn't be back to 37 because he's proposing overall rates go to 39.6% at the top. So the professionals go from 37 to 39.6, but the non-professional services companies go from 29.6 to 39.6. 10% is huge. I mean, it's a 1/3 tax increase for you guys because 10% over the current 29.6, called 30, is a very substantial increase. It's an increase of about 1/3. So the QBI elimination is another negative tax implication from the Biden plan. And by the way, that would be a return to what existed before the Tax Act of 2017, which was 39.6 top brackets and no carve out for the benefit of private business owners with flow-through entities, as we've discussed. Another concept that is in the tax plan of concern would be stepped up basis. So let me explain a concept that any of you who've taken time to do some estate planning probably understand. But the tax code enables us to leave money to our heirs, to the people we want to leave money to, some money to them tax-free, estate tax-free. So basically, what it means is that under current law, each of a husband and wife, if they're a married couple, can leave $11.5 million tax-free to your heirs. So 11.5 plus 11.5 is $23 million under today's law that you can leave to your heirs. That's going to change. Under current law, that retreats back to $5.5 million each for a total of $11 million for husband and wife in 2026. That automatically happens. That is not a change. Under the Biden plan, as proposed, it was to retreat it back to $3.5 million each. So that's $7 million. So from a estate planning perspective, that's a heck of a change. 23 million down to 11 is a heck of a change, but down to 7 is a real heck of a change. So our clients who typically sell for significantly more money than that, it means that they're going to be leaving more money behind that's subject to estate tax. And the estate tax rate is 40% today. Today, that's pre-Biden tax plan. So if, by way of example, we have the 2026 tax rates of $3.5 million each, this is the way it is right now. If I died in 2027, and I'm going to make it my wife and I both dying because the math's easier to understand, we'd have $11 million we could give to our families tax-free. But if we had $21 million, extra 10, $4 million would go to the federal government, and here in the state of Ohio, 5% would go to the state. 45% of that last $10 million disappears. It's gone. My family would get 55% of the last $10 million, the other 45% to the government. The Biden tax plan proposes to increase that 40% to 45% for the estate tax, and to lower the $5.5 million, which is the 2026 law, automatically to $3.5 million. So let's go back to my facts. If I died with $21 million and only $7 million were exempt, $14 million would be subject to that 45% tax rate. Federal plus 5% state, that's 50%. So under my made-up facts, 21 million minus 7, quick maths, 14 million, the government's getting 7 of that last 14, my family's getting 7. So the tax rate goes up, but for many people, the bigger impact, depending on where you are, is that the exemption amount goes from 21 to 11 automatically in 2026, but the proposals take it down to 7 for a married husband and wife. If you're single, you get half as much. So estate tax and estate tax planning becomes more and more valuable. In our ESOP transactions, we try to be very creative in estate planning. We work hand in glove with the wealth advisors and your estate planning lawyers in order to construct opportunities to lower the amount of your estate tax. And during 2021, before the tax law changes, we can get a lot more money into your irrevocable trusts and save a lot of estate tax. I started this section by mentioning the step up in basis and then went to the change in the tax rates because that was probably the better way to do it. The step up in basis is the final concept I'm going to really talk about today. Step up in basis means if I die, all of my assets are valued on the date of death to determine if I have a capital gain. So let me give you an example. Let's say I bought a stock for $10 10 years ago, and today it's worth $500. I was a really good investor. If I sell it today, $500 minus the $10 I paid for it, that's called basis, I have a $490 gain, and I would pay about 25% tax rate on that. Okay? Under the Biden plan, I'd pay 39.6% plus 5% for about a 45% tax rate. But this is what's interesting about estate tax law. If I were to not sell today and sadly die tomorrow, and my family and the estate sold that same stock for $500, there would be no capital gain at all. The $10 that I paid for it, my basis, would on the date of death be adjusted upwards to the value on my date of death, which is $500. Now if I sold the stock for $500, my basis is $500, therefore I have zero taxable gain. So step up in basis is a really important element of estate planning because it allows you to never pay the income tax. So in a 1042 transaction, we can escape income tax. 1042 defers income tax until death, and it gets escaped because of step up in basis. You defeat the income tax upon the date of death. Here, with a no step up in basis, the defeat of the income tax doesn't necessarily occur if this is accepted into law, which no one has any idea it is. But something to understand about 1042 is your date of death doesn't trigger the income tax. It's holding the assets you bought when you rolled over your gain from the ESOP. So you don't have to pay income tax ever under 1042. You defer forever, even if stepped up in basis goes away. It doesn't take away the tax benefit that an ESOP can confer. So I recognize some of these concepts are a bit complicated because they are. That's not your imagination. Our firm is, I think, incredibly focused on tax planning as a vehicle to increase our clients' outcomes. And if you watch this and you'd like to learn more, we're going to have a link that you can easily reach out to me, and I'd be delighted to put you on the phone with myself or one of our other tax lawyers here for the purpose of having a discussion about how all of these impact you and your family's wealth, your estate planning, and ultimately whether an ESOP presents an optimal outcome for you because of the tax benefits resonant within the Internal Revenue Code. And by the way, one final closing thought. No one's proposed to do away with 1042 or to the other tax benefits within the ESOP provisions, because both sides of the aisle really believe in employee ownership. They really believe in having your rank and file employees getting a slice of the American dream, which is ownership in the company they work. And they all believe that the selling shareholder, in order to incentivize him to help his employees, they want to give him a tax break so that your employees have an opportunity to be owners of the company rather than merely employees with some, competitor or private equity firm being the owner of all that value over time. I appreciate your time today. Again, feel free to reach out to me directly. All the information will be on the screen, and I look forward to helping answer any questions you may have. Have a great day. Thank you.